Chapter 10, Part 1, what we're going to do is go over issuing stock and some general overview of the chapter in terms of stock itself. So, corporation, what are the advantages and disadvantages? Why do people set up corporations versus sole proprietorships versus partnerships? Well, they have advantages. They're a separate legal entity, and that helps in terms of litigation. It has continuous life, which means that if the owner leaves or dies, like in sole proprietorship or partnership, the company, in essence, is dissolved legally, whereas in the corporation, that's not true. So, it has continuous life in that regard. Transferability of ownership, and that has to do with the fact that they issue stock, and therefore people can buy stock and sell stock in terms of how they own it. Limited liability, because usually it's very difficult to sue the individuals versus the corporation. And the biggest advantage is ability to raise capital, and they do this by issuing stock. Now, what are the different disadvantages? Well, there is a separation of ownership and management. So if you're the kind of person who wants to maintain control, once you become a corporation and issue stock, you may lose that. Double taxation, because the corporation is taxed as well as the dividends that are given to stockholders as rewards for investing in the company. And there's a lot more government regulation. Now, how are they organized? Well, first of all, you have the Articles of Incorporation. This kind of lays out the overall structure of the company, and this is what you have to do, and you file this with the state. And it's called your corporate charter. Capital stock is stock that represents ownership of a corporation's capital. Shares is a basic unit of stock. Authorized shares are the number of shares a corporation is issued to the public, i.e. they've sold to the public. Stock certificates is what you used to get when you bought stock, but you don't get them anymore. Now you just know you have so many stock. And outstanding stock is stock that is owned by stockholders or issued less any stock called treasury stock, that's stock that's bought back by the corporation. Now, what are the two sources of equity? Well, there is paid in capital, which is when we issue stock and we get cash in exchange for giving up ownership. And we have retained earnings, which is our cumulative net profit. Because as we know, at the end of each year, we transfer the balance of our revenue minus expenses to retained earnings minus any dividends, and that's what carries forward. So remember, retained earnings is cumulative, and we subtract dividends from that. And as a matter of fact, you cannot pay dividends if you don't have positive retained earnings. Now, what about classes of stock? Well, we have two general categories that are common, which are the most prevalent. These do pay dividends, and they can receive assets if the company is liquidated. If there's anything left, which usually there isn't. And then there's preferred stock, which is most companies don't have preferred stock because they have a stated dividend, which means that if dividends are declared, it has to first go to the preferred stockholder, and they have to be based on the percentage that's shown as part of their stock certificate. Now, sometimes they have conversion features where they can convert from preferred to common if the price reaches a certain point, but that's in a whole different chapter, so don't worry about that. All right, and remember, there are many forms of common stock. We treat it like there's only one, but really, if you were to look at someone's financial statements and look at the equity section, you will see that although they may have common stock, they may have class A, B, C, and D. Now, very seldom will you see preferred stock because, again, of the dividend requirement. But it's only required if they declare it. Now, what's the comparison of issuing stock versus debt? Well, if you issue stock, whether it's common or preferred, you don't have to pay it back. But long-term debt, you do. Dividends interest. Dividends are not tax deductible in either common or preferred, but interest is. Obligation to pay dividends, again, for common and preferred, it's only if declared, but if there are common stock and preferred stock, if it's declared, it has to go to the preferred first. And long-term debt, they have a fixed rate that has to be usually paid every 6 months. Now, when we talk about stock values, i.e., what amount do we book to the account common stock or preferred stock? It's the same in terms of accounting-wise, except a different name for that account. Now, we talk about par value. So, remember first that stock may carry a par value, a stated value, or it may be a no par stock. Now, if it has a par value, it is an arbitrary amount, usually set at a very low amount, sometimes like a penny, and it's in the corporate charter. Stated is an arbitrary amount after the corporation has been established. It's assigned by the board of directors. And then you have no par stock. You have no par stock, and what it means is that any amount you receive goes all to the stock, and none of it goes to a different account, which we'll talk about. Now, stockholders, they have the right to vote, they have the right to dividends, they have a right to, if the company's liquidated and there's anything left, to get some of the assets, and there's the preemptive right. Now, the preemptive right says that if you own 5% of the corporate stock, if they come out with new shares, they have to first offer to you the option to buy new shares so that you maintain your percentage ownership. But it is seldom shown for most stockholders because, as you can see, that would be a disadvantage if the corporation was trying to make it so somebody didn't have a lot of influence. Now, a company neither earns a profit nor incurs a loss when it sells its stock to or buys stock from its own shareholders. So remember, there's never any profit involved in buying and selling your stock. Now, what if they issued 10,000 shares of common stock if the par value was $2 and they sold for $200,000 cash? You'd get cash. The common stock is always going to be booked based on the number of shares and the par value or stated value. So common stock is going to be, and remember, since it went up, it's a credit because it's an equity account. So common stock, you're going to take that $2 par times 10,000 shares, and of that 200,000, 20,000 is going to go to common stock, and the balance, which is a plug, goes to APIC, additional paid-in capital, and in this case, common stock. So that's a plug. Now, what if instead they issued 10,000 for 200,000 and there was no par? Remember, if there's no par, there's no additional paid-in capital. Now, 3, what if instead they issued 10,000 shares of no par common stock with a stated value of $5? It would be 200,000 for the same amount. 200,000 cash, common stock would get $5 times 10,000, and the difference would go to additional paid-in capital. Now, what if instead you got a piece of equipment? Well, the way it works is that the rule is if the stock is widely traded, you use the fair market value of the stock. If it's not, you use the fair market value of the asset received. Now, in this case, we're assuming that the asset recorded at their fair value is similar to the fair value of the stock. So, in this case, what we're going to do is the equipment's going to get 800,000. The common stock is going to be 50,000 times the par, and the difference goes to additional paid-in capital. And that should say dash common stock. Now, what about preferred stock? Well, it's treated exactly the same, except it's got a different account. So, and in most companies, they put all the paid-in capital and excess par in the same account, but some, in your homework, you might have to break it out. I'm not sure. So, can be issued with conversion feature. We talk about that in intermediate accounting, not in this class, so don't worry about it. So now let's go through an example. So we have a company, they have 100,000 shares of $10, no par. Now you're probably wondering what that $10 represents. Well, here's how it works. For preferred stock, their dividend is normally a percentage of that dollar amount. So if they issued, if I showed a percentage of 10%, it would mean that when there were dividends declared, each person would get what? $1 per share. So that's why you see it, but it's a no par stock, which means any proceeds goes directly to preferred stock. And they have 500,000 shares of common stock authorized. During February, their first month of business, they completed the following transactions. On February 2nd, they issued 100,000 shares of $1 par common stock for $15 cash per share. So our cash would be the amount we issued it for times the number of shares, gives us 1,000,005. Common stock would be $1 times the 100,000 shares, and the difference would go to APIC. Now on February 3rd, we issued 5,000 shares of the no par preferred stock for 100,000. And as we know, when there's no par, it all goes to preferred stock. Now, on February 20th, we issued 600,000 shares of $1 par value stock for equipment with a fair value of $9,000. So we're going to go equipment, $9,000. Common stock is going to be the par times the number of shares, and the difference is going to go to additional paid-in capital common stock. Now, we will talk about this later once we talk about treasury stock. But remember, authorized is the maximum number of shares a corporation can issue under its charter, which means if they go beyond that, they've got to change their charter. So normally, authorized is a pretty high number of shares. This is a cumulative total from the company's beginning up through the current date. Outstanding is the number of shares the stockholders own. That is the number of shares outstanding in the hands of stockholders. Outstanding is issued stock minus treasury stock, which we'll talk about in one of the other parts. So, treasury stock is stock that has been issued and then repurchased and held by the company. So now let's look at the last thing, is the stockholders' equity section. So, if we had retained earnings of $250,000, we're going to use our same example we just went through. Paid-in capital, we'd have preferred stock, $10 no par. We issued 5,000, issued and outstanding, and we have 100,000 authorized. Common stock, we have $1 par. We have 500,000 shares authorized. We have 100,600 shares issued and outstanding. And then we have our paid-in capital in excess of par from the two issues. And that tells us our total paid-in capital. And then we have our retained earnings. This is exactly like your first problem, so that's why I did it this way. So now we'll move on to part 2.